Hey, welcome back. After a few very rough years following the pandemic stay-at-home hype, PayPal is now finally getting some attention from the market. However, despite an overall good quarter and year, a huge buyback program and an outlook above expectations, the stock fell by even 10% on the day of the release. We can see the company improving even in an unfriendly environment, with growth rates above the financial sector medians. But now they are beginning to fall, so keep that in mind. The double-digit profitability is okay, but behind the sector median. But to be fair, banks in general had an amazing time recently, so not the best 5 years to compare. After a bunch of acquisitions and developments, they can make around 5, 6, even 7 billion per year. For a 90 billion market cap, that's a ratio of around 15, which is very cheap for an American tech company and even for them. Before the pandemic, they were at 20, 25, 30, and at some point, not even a year ago, it fell to around 10. I know it's not the best company or anything and the growth slowed down recently, but at the end of the day, it's still the market leader and making a ton of money. Nike, who makes the same money, has similar issues but didn't grow at all in half a decade, was at like 3 times higher prices. Financially, we see a very good position with the current assets around the total liabilities and not a lot of debt. There is 20 billion in equity on a much higher market cap, but that's normal for a tech company that has a lot of digital assets that you can't really put on the balance sheet. Think about the code behind PayPal itself, the app, the brand and so on. It's impossible to value something like that, and it's ultimately up to how much a buyer would pay for it. But again, very healthy, and they also have a lot of treasury stock that they got at lower prices that they can use for an acquisition or maybe more. Now, something definitely impressive about them are the buybacks. In recent years, they paid 3, 4, 5 or even more billion and ramped them up during the time when the stock was down. Now, that's like a 6% yield from even 10% a year ago, which can always be turned into a dividend if they think the stock isn't cheap anymore. Now, I have to mention again that rate cuts could be really good for a company like this. The role of high interest rates is to slow down the economy to fight inflation. When they are cut, it does pretty much the opposite. So higher transaction volumes, more new businesses, more borrowing and so on. They actually did very well during a bad environment and I really want to see what they can do now. They should thrive in such an environment and we can see the previous performance. But keep in mind that the competition remains an issue. If they want to develop even more in higher growth regions like SEA or South America or even Europe, that's full of powerful fintech. But they have the advantage of being a very popular brand and already making a ton of money, which can help a potential expansion. Plus, the higher valuation can also allow them to issue stock if they want to develop. We see PayPal actually dominating the online payment market with a roughly 45% market share despite all the competition. They are very popular in both online and POS in many countries, as you can see. Now, there is the issue with Honey, the add-on that scouts for coupon codes on checkout. It's too early to assume anything, but it was a small side of PayPal that they bought for like 4 billion half a decade ago. I think it's more about losing the customers, partners and the trust than what they'll have to pay in the lawsuit itself. The settlement, if any, will probably be a few million, but again, the future income is what I'd be more worried about. But again, small side of the company, so at most I think it would be just a bad investment for them. I guess another issue would be someone like Amazon or Apple joining the market. And Apple is already in the market, but not exactly on the same things. Maybe they could even buy PayPal if they issue like 5% of their market caps, so not much. Amazon and PayPal actually started working together in September 2024. It would be a huge step if they want to develop even more into that kind of infrastructure for businesses as a service. Now, since they have a new CEO, they are doing a ton of changes in the management, even one a few weeks ago. I called Nike's necessary and it ended up happening, but for PayPal, I don't know if it was that mandatory because the company was doing okay given the environment. But with so many changes, they could maybe shift into a higher growth company rather than a stable cash cow, which could attract a higher valuation from the market. And if anything, they have the money to develop a lot. You know, a year of cash flow or issuing some stock could buy entire market leaders in some countries, so there is potential. I know that there is some debate in the market about their high stock-based compensation. As a parenthesis, it's probably a bit higher now since a lot of the management team was replaced and they probably had to give some both to the ones that left and the new ones, which is a one-time thing, but they were high even before. Let's say 1.4 billion on a 5 billion cash flow is 28%. You can say, yeah, but the stock didn't go anywhere, so why reward them? It's usually more about the business rather than the stock. Meta, for example, paid like 60% of the cash flow in 2022 when the stock crashed like 80%, and if you compare it to 2020, it pretty much doubled. So it's quite a bit of money on an absolute level, but not that high for what they are. Now let's see a valuation. In a bad environment with higher competition pressuring the margins, let's say they stabilize at around 3.5 billion per year. Traded at a ratio of 12, which is relatively okay given the big drop in cash flow, and that's a market cap of 42 billion. That means a price of around 41.9, which is a 50-something% loss, so quite a bit. If they pay half of the cash flow as a dividend or buybacks, that's a 4.2% yield on that price, so it could attract some attention. But again, in such a position, a company like Apple or Amazon can simply buy them for like a 3% dilution. You know, they are valued at like 30, 40, 50x the cash flow and can buy something at 12, 15x and also generate synergies on top, so the value for them is actually huge. In a second scenario with higher competition but also a better environment thanks to rate cuts, let's say they make around 5 billion per year. For a ratio of 15, that's a 75 billion market cap, meaning a price of 74.83. That's a 15-20% below the current level, but with a 5, 6, 8% buybacks per year, this can be much better in say half a decade. You know, that 74 is based on the current number of shares, and if they cut it in half by 2030, let's say, the price is by default 150. Not to mention that the buybacks also generate demand, which can lead to a higher price to cash flow ratio, so potentially much better. In a better scenario with another acquisition and a good environment, let's say they make an average of 6.5 billion per year. For a ratio of 20, that's a market cap of 130 billion, meaning a price of 129.71. That's a 40-50% profit plus, again, the potential for buybacks, making it a multi-bagger. I think in my previous videos my target was something around 50-60 if I remember correctly, and indeed that was quite cheap. Now it's not really that cheap anymore, but at the same time it's very cheap for such a solid American cash producer doing some of the highest buybacks on the planet. If they want to switch it into dividends, that's still a massive yield that can attract even more attention. Even in an unfriendly environment, this company managed to develop quite well, and now with rate cuts everywhere on the planet, they have even more potential. Sure, they are lacking in some aspects, but they can make so much money that they can buy or fix pretty much anything they want. So overall a good company in a healthy position that can make a ton of money. Even if they lower the margin to fight higher competition, the time after rate cuts can be very beneficial. I think now with maybe even higher buybacks plus a potentially improving environment, there is potential to see them do pretty well. It probably won't get back to the pandemic peak because that was mostly hype and market hysteria, but fundamentally this remains a very solid company and a global market leader. At the same time, I looked into maybe even more interesting competitors with a lot more potential in Brazil and SEA, so make sure to check them out as well. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.